Interest rates are starting to come down, but what does that really mean for home buyers, sellers, and the housing market in general, especially here in the Myrtle Beach market? So, as of this morning, the 30-year mortgage rate national average is hovering somewhere around 6.5%. It has come down a good bit since the peak of 8% just about a year and a half ago. Now, the good news is we can almost, with a 100% certainty, anticipate that the rates will come down moving forward. We just don't know whether it's going to be now, whether it's going to be at the end of the year, early next year. But definitely, from what we're seeing, by late end of May next year, when we have a new Federal Reserve chairman, the next one coming in is supposed to be pretty aggressive in dropping the Fed rate, which should push interest rates down. So, what does that mean? As rates fall, here's what the experts are projecting. Right now, we're at 6.5%. If we get to 6%, National Association of Realtors, NAR, is forecasting that 5.5 million more households could suddenly afford a median price homes. So that means more buyers entering the market, more showings, more sales activity. To kind of put that in perspective, right now we're averaging somewhere in a range of 4.1, 4.2 million homes sold over a 12-year period based on the track that we're on right now. So going from 4.1, 4.2 to 5.5 is a pretty significant jump. 5.5 gets us back to where a normal market is. That's typically how much we sell in a year nationwide. So if we get to 6%, which we're not that far off, we could be back to a normal housing market. Now, if it goes lower than that, let's just say it goes to 5.5%, we're going to see a lot of pent-up demand right now, and buyers finally get released. We know there's a lot of buyers out there. There's a lot of millennials and Gen Zers that are out there that are wanting a home, their first home, but can't afford it with the current prices and the interest rates. We get to 5.5 or somewhere between 5.5 and 5%. That's going to release a whole bunch of those that now all of a sudden can afford a home. So they've been waiting on the sidelines. They're going to jump in the game. So the way we're going to see that is, first of all, you'll see the rates start to come down. Then the leading indicator is going to be more mortgage applications coming in. So we're going to see a spike in activity with lenders, mortgage applications coming in. We're going to see more refinancing as well, because a lot of people came in at 7%, 7.5%. And this would be a good time at that rate for them to refinance. So we're going to see a lot more competition for homes ramping up. If we get below 5%, anything with a 4 in the beginning of it, things could really take off. So at that point, we could start seeing a lot of pressure on inventory. So we should see inventory start to really decline. As inventory declines and tightens, we can see home prices accelerating, making affordability, because the affordability at that point is so good for people. So I don't know where it's going to go. I don't know if it's going to go to 6. I'm pretty sure it's going to break 6. We don't know where it's going to be in the 5s. I doubt we'll break 5, but who knows? It's something to pay attention to. But if you're waiting on the sidelines, looking for the perfect time or the perfect opportunity to buy or to sell, just keep a very close eye on what the mortgage rates are doing. And if you want to even get ahead of that a little bit, keep a very close eye on what the Federal Reserve doing and what the Fed rate is, because there's a direct correlation between what the Fed rate and the 30-year mortgage. So every single drop in the mortgage rate changes the level of competition in the market. So if you want to talk about mortgage or buying or selling here in the market and how it impacts you, please reach out to me. I'd be happy to walk you through the numbers.